Hello from Trend Signal for our review of the data and events of the week beginning the 13th of March. US clocks have been put forward by 1 hour for daylight savings. The differential, therefore, between the US and UK/European clocks is now just 4 hours, and that's until we push our clocks forward on the 26th of March. Monday morning, indices mixed overnight. The Nikkei flat, Hang Seng up about 1%. A very big week for the markets, with the Federal Reserve. The last piece of the economic jigsaw fell into place last Friday with a strong non-farm payroll or unemployment reading in the United States. The number beat consensus by about 40,000, whilst the previous month's number was up by 10,000 as well. And I think this last piece of news makes Wednesday's Fed rate decision a foregone conclusion in most people's opinion. So the Fed will raise rates by 0.25%, quarter of a percent, the second rate rise in 4 months as the US economy finally starts to normalize following, well, a very prolonged financial crisis. Last week, markets were on hold mode, really. The FTSE, Dow, S&P, DAX, all down around 0.5%. The only major market that was different to that was the Nikkei, rallying about 0.7% on the back of a weaker yen. Other markets movements, the dollar surprisingly weak actually towards the latter part of last week. The euro tacking on another 50 points. Sterling was the very weak one amongst all the other currencies, certainly against the dollar. Sterling dollar rate falling 130 points, which is what, 1%. Really, it's all to do with Brexit and the House of Lords amendments, etc. But that seems to be coming to a head, possibly by Tuesday this week. More on that in a minute. In fact, the triggering of Article 50 of the Lisbon Treaty, that could happen tomorrow. I might as well tackle it right now. If the House of Commons rejects the Lords' amendments, as it seems likely, according to the press, then it goes back to the Lords, where the Labour peers apparently are unlikely to continue to oppose the Commons. That just leaves the Liberal Democrats. So, likely, possible, that Article 50 of the Lisbon Treaty could be triggered Tuesday. So what happens when it's triggered? The answer to that is probably not a lot. It's more symbolic than anything else. Certainly the market knew it was going to happen. Sterling has fully discounted a lot of the bearish news, so we don't expect too much there. If anything, sterling remains undervalued, so you're going to continue to experience bouts of strength whilst negotiations gather apace. Obviously, depending on how the negotiations go, but to try and predict where sterling is going to be in 3, 6 months, 9 months, a year's time is absolutely impossible, as this has never been attempted in terms of the triggering of Article 50 and a member state leaving the Union. So that's Article 50. Other markets that have been affected last week, gold was particularly weak on the continued slide as the global macroeconomic threat that was perceived to be increased by Trump seems to have subsided quite a lot. The other major news was the slump in the oil price. Brent oil falling $4.50, WTI falling $4.9. That's what, 9.25%. The oil price slumping further on Friday. 9% on the week, massive build-up in stock since January. For some reason, the market seemed to ignore this build, preferring to focus on OPEC's position, resulting in almost a becalmed, very stable market, but no longer. US stocks increased another 8 million barrels last week, and that's a total of over 50 million barrels since the start of the year. This isn't just shale oil production increasing, but obviously other things like rising imports of oil from the likes of Saudi Arabia, Iraq, and Nigeria. Big question that traders and big hedge funds have is, will OPEC decide to extend their production cuts for another 6 months? These funds who've bet heavily on oil suggests, certainly the last week's move suggests that they're not altogether sure anymore. Data and events this week. Let's deal with the major one first, which is the FOMC meeting on Wednesday. Happens at 6 o'clock. Remember, normally at 7 o'clock, but with the daylight savings is just that 4-hour differential, so make sure you put in 6 p.m. as a reminder. According to the Chicago Mercantile Exchange, the implied futures contracts, the probability is 89% for a rate rise. So there we go, 89% for a rate rise. I put it higher than that. It looks like a shoo-in. But what will be of greater interest is what is said in the press conference at 6:30 p.m. post the announcement. Maybe we'll get a greater idea about what future interest rate rises there could be. Certainly it will have an effect on the foreign exchange markets, bond markets and equity markets. I think the euro is particularly strong against the dollar at the moment, where you'd expect to see the dollar strong. But I think Mario Draghi's comments towards the end of last week regarding the pickup in growth in the Eurozone, and the markets are now speculating about QE tapering and even a possible rise in interest rates in the Eurozone, which is quite a turn of events, really. Other data this week that is probably going to be overshadowed, certainly by the FOMC, which really is a key event, certainly in the first half of this year, really. We got US CPI inflation data on Wednesday morning. I say Wednesday morning, 12:30, lunchtime, early lunchtime. Very benign reading, and with a fall in crude oil over the last week, the chances of a pickup in inflation in the States remains fairly subdued for now. We also have core retail sales out as well. Slight dip from the previous month's strongish data. Regular weekly crude oil inventories, that will attract even more interest in light of the recent slump in oil. And then we have our FOMC meeting. We've already discussed that. We have 3 other central banks meeting this week. We got the Reserve Bank of Japan early morning on Thursday. We got the Swiss National Bank also early Thursday morning, expecting no change whatsoever. And we have our own Monetary Policy Committee here from the Bank of England, 009, so no chance of any changes in monetary policy at all from the Bank of England, accompanied also by the minutes, etc., but that will not attract too much interest. We then have manufacturing data out from the States, 12:30, remember, an hour different to what it normally comes out at. Bit of a pullback in manufacturing. There had been a general slowdown in manufacturing, nothing that is too worrying for now. And then we've ended the week with the prelim reading of the University of Michigan consumer sentiment number, a very strong number indeed, again expected, 97.1. That's it. Thank you very much for listening. All the best. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.